Hey, good evening, everyone.
Good
Yeah, good
evening,
evening, Professor.
Tom.
Hey, how are you, Damien? How are you, Ibani?
I'm good, and yourself?
I'm good too.
Happy Thursday
Yeah, happy Thursday to you too.
to you as well, Damien.
Damien?
Thank you, thank you, thank you.
All righty. Now, I s- I have only two people, and the third person, Ethan, is just joining. Ethan has just joined, so we have three people. How are you, Ethan?
I'm great. How are you, Professor?
Great, great. Happy Thursday. Now, so we have three people, so we're still waiting for some, more people to join, because before I came to the collaborate, so this is the number of people I have in the discussion board. Um, just five people. Just five people. This is bad. And then three people in the collaborate. So waiting for more people. Okay, one more person is joining. Anna. Okay, Anna has joined. How are you, Anna?
Hi, good. How are you, Professor?
Good. How are you? So I'm. So it will pick up. Sooner or later it will pick up. Uh, it will pick up. Let's see. I mean, people haven't quite uh, come to class yet, but let's see. Within the next 5-10 minutes, I will have more people. Well, so to actually by the main lecture, we are, as of today, we are already finishing up topic three. And when the topic three is finished, then there will be a second midterm. Okay. The announcement will go out tomorrow, and it will be you'll still have you'll still have time, plenty of time for uh, you know the announce. It's the if the announcement goes out tomorrow, then the actual exam will be you know uh, at least 5 days 5 days later at least, and the announcement is always in advance, at least 5 to 10 days, 1 week ahead. And if you go to the McGraw-Hill, you will see midterm 2 is scheduled for 29 through 31. Okay, so look out for that announcement. Now, so we need to wrap up, but it takes so much time. We got to get to we got to even wrap up. We haven't even wrapped up the second topic, which is stock valuation. But I'll give it the best shot, because today is, I believe, eighth week. This class must be the eighth. This must be eighth week, and I can tell. So if I go to see, the last recording was recording 7. That means it was seventh week, and so today is eighth week. Okay, today is eighth week. And we did, I tried to do as much as possible, within. So, oh, Last week I was in a rush because we were at the end of the our 3 hours. So I was in a rush. So I made a little mistake because remember, plowback ratio, which is 1 minus dividend payout ratio, 1 minus dividend payout ratio. Uh, this is quite important because that's what determines the growth rate. Because growth rate is, and I'm gonna write it here. Okay, it's very important because growth rate is basically a return on equity times plowback ratio. Okay, so and then so the difference between the company that is who's paying dividend and not paying dividend, right? That difference is called the present value of growth opportunity because first, if a firm is growing, I mean, if if the firm pays dividend, first of all, there will be two cases. Um, Dividend is growing, dividend payout ratio is growing. In other words, at the growth rate of G, or dividend is constant, that means growth rate is 0, right? So I had to compare it with the third case where dividend payout ratio is 0, uh, which means I mean not 0 but 100%. What am I? Okay, if the dividend payout ratio is 1, paying out entire dividend, I mean entire earnings as dividend, right? Entire earnings, paying out entire earning as dividend, then there, a plowback is 0 then. Plowback ratio. Plowback ratio is 0. Then in that case, value of such a company, right? Stock price, value of such a company, which has no growth, which is no growth firm, right? Will be simply earnings per share at time 1, right? Divided by R. R and K are the same thing. I mean, sometimes you will see, I use R, sometimes K, but K is the cost of capital. And in case of stock, cost of capital is cost of equity. So you will see that, K and R being used, interchangeably. And in this case, it will be growing, but dividend is constant, right? It's growing, but it's paying constant dividend. In that case, it's going to be just dividend over R, because dividend growth rate. And in this case, and if it is growing at a constant rate, right? The bar on top means it's constant, right? It's growing, dividend is growing, but at a constant rate. Okay, that makes sense. Then in that case, then it is, dividend at time 1 divided by R minus G. Okay, so I should have said, because last time I was in such a rush, I didn't consider case number 1, but only compared case number 2 and case number 3. But, between case number 1 and case, in other words, between model number 1 and model number 2, this is, constant growth model, right? When dividend is growing at a constant rate. This one is, zero growth model, or, constant dividend model, right? Or perpetuity model. Between the two, obviously, between, let's call this 1, okay? Model 1, right? Or constant growth. Let's call this zero growth. Okay? Of course, if you compare all of them, right? Then, of course, the value of the stock that grows at a constant rate will be greater than the value of stock, right, with zero growth, which will be greater than the, I mean, if they all have, like, same R, right? If they all have same R, same, required return, and the dividend 1 is greater than dividend, constant dividend, right? And then the value of the no growth firm, right? But, bottom line is the difference, whether it is the difference between constant growth firm and whether it is the difference between constant growth firm and no growth firm, or whether it is the difference between value of the zero growth firm and the value of the no growth firm, right? This difference is called present value of growth opportunity. Present value of growth opportunity. Now, once again, this is I don't like to call it, this way, because it's, I mean, yeah, that's true. It's the, the difference between a company that pays 100% of its earnings per share as dividend, which has, clearly no growth potential, because nothing is plowed back, nothing is, reinvested. So obviously the only explanation between the the only explanation for the difference between these two prices, obviously these will be higher, right? These will be higher. These numbers are higher. So, obviously, you can explain that and you might wonder, you can, okay, so and the only way it can be explained why these, growth firms are, this one is growing. You can't say this is a growth firm because, but still, it will be growing because the stock value will be growing. I mean, what I'm saying is it's not dividend isn't growing, but stock value will be growing because, there's plowback, right? So why are these, higher in value? Mathematically, it is explained, but the reason people are paying higher prices is because it's it represents the difference represents the present value of growth opportunity, and people are paying higher prices for that growth opportunity. But again, the growth opportunity is such a fleeting term, fleeting concept. Why? Is the growth opportunity really, is it going to be realized? If it's going to be realized, sometimes, it doesn't come through. It doesn't come true, right? It doesn't come true. Sometimes it comes true. Sometimes it doesn't come true, right? It doesn't get realized. And also, you might, mathematically, there's a little problem here. I mean, dividend, if the company, you can't make a direct comparison actually between number 2 and number 3. You can't make a direct comparison. Why? Oh, no. You can't make a direct comparison because how do you know? How would you know? I mean, if EPS, earnings per share, is, let's say, R is the same thing, right? For all these three models, R is the same. And if it is the same company, right? It cannot be the same company because the one company cannot have two different dividend policy, right? But if let's say it's the same company under two different scenarios. In scenario in scenario one, okay, scenario two and two different scenarios. So in these three scenarios, right? Let's say scenario 2 and scenario 3. Let's take a look at if it is the same company and the company has two possible scenarios. One, they pay constant dividend. The other, they pay out all the dividends, all the earnings as dividends. Under scenario 1 and under scenario 2, of course, if it is the same company, then scenario 3 will result in a higher stock price, right? Why? Because earnings per share, if it is the same company, right? Dividend is only part of earnings per share, right? Dividend is only part of earnings per share. So smaller numerator, bigger numerator, same denominator. What's going to be, what's going to be the what's going to be the value of the fraction? Well, of course, this will have a greater number, right? Uh, the fraction of number 3 will have greater number. Uh, so mathematically, it may not make sense, but uh, uh, but the reality is, you cannot have two different scenarios for one company. I mean, at the same time, you will have either scenario 1 or scenario 2, and if they are different companies, um, you know, the amount of dividend and amount of earnings per share will be different, and the R will be different, right? Required return will be different. But one thing is for sure, right? Um, scenario one, scenario one will always end up greater. Scenario one will always end up greater than scenario 3. Why? Because because of smaller, smaller denominator. Because if it is the same R, think about it. If it is the same R, right? Right? In all these scenarios, if it is the same R, what's going on? Why? Yeah. If it is the same R, it's R minus G, same R minus G. So with a smaller numerator, this will, scenario 1 will have to end up, scenario 1 will have to end up bigger, right? It will have to end up in a bigger number than scenario 3. Okay? Now, so you might be, without, getting bogged down too much in this, just wanted to provide mathematical background, for present value of growth opportunity. But then, as I said, present value of growth opportunity is it can be realized, or it can sour. Why? I've been telling you over and over that Tesla has been grossly overvalued. It is still grossly overvalued now, but in 2020, early 2020, it was more grossly overvalued. Why? How do I know if it is overvalued? Because this is a constant debate in finance, because Tesla's earnings per share. I mean, looking at the price earnings ratio, we talked about price earnings ratio last time, right? I told you the reciprocal, right? Price earnings ratio raised to -1, the reciprocal, which is then earnings price ratio, right? But this is called what? Earnings. I told you this is called earnings yield, right? Remember, we spend so much time on different types of yield, and then we talked about dividend yield, right? Talked about which is called dividend yield. And think about it. Either earnings yield or dividend yield is what, you know, the stock investors, right? That's what the stock investors are after. I mean, uh, you want these numbers to be high. I mean, if earnings yield is high, what does that mean? For the same price, I mean, you have more earnings, right? The higher this number, the higher this number, or higher this number for the price that it pays good dividend. For so the higher this number, the better it is. But then that means if this number is higher, that means this number will have to be lower. Isn't that right? If this is higher, if this goes up, then this will have to go down because they are reciprocals, right? And then, uh, so I told you a low price earnings ratio is an indicator of it's an indicator of uh, undervalued stock, right? Low price earnings ratio it's a good value for money, right? And I don't want to go over this again because it's logically, I mean, if you cannot follow the logic, then you are in serious problem. Because for being to be in Finance 300, I mean, that kind of logical reasoning should be like your second nature. And then a lot of also we want this number to be high. And I also talked about capital gains yield. What's a capital gains yield? It's basically P1 minus P2, right, over P1 P2 minus P1 P0. Okay. Okay. P1 minus P0, right? The growth in the stock price, that's called capital gains, right? Oh, I'm sorry, this has to be P0. I'm just, because I'm talking and I'm speaking and, writing at the same time. I selected eraser. Why? Yeah, it's, the computer is slow. It's delayed. Okay, this is called capital gains yield, right? Yield is another name, another word for return. So, yeah, earnings yield, dividend yield, capital gains yield, no matter what, the higher this number, the better it is. Isn't that right? The higher the number, the better it is. Another thing was another thing we talked about was current yield. Current yield is a bond, right? Annual coupon. Because in the short term, right? Short term means less than 1 year. Within the less than 1 year time frame, I mean including 1 year, right? What is the maximum return you can get? It's 2 coupons or the annual coupon, right? And also if this number is high, of course that's good, right? If that number is high, that's good. And this is called current yield, right? and that's bond. That's in case of bond. But now let's think about it. So if earnings yield is high, right, that's a good thing. And if earnings yield is high, the reciprocal price earnings ratio will have to be low. So low, as I said, low price earnings ratio is a value stock, right? And Warren Buffett is like the figurehead, right, for of the school. I mean, Warren Buffett is known for value investing. He is, his strategy is, basically find the undervalued stock, right, and invest in it, because undervalued stocks are priced priced lower for its earnings power, right? And the earnings power, it's obvious, right? It's obvious that the higher the higher the earnings yield, that means more earnings power, right? And there are two camps, right? Two camps in the financial market. One camp is one camp champions or advocates high price earnings ratio. Okay. Another camp champions or advocates low price earnings ratio. Okay. And the reasoning for low price earnings ratio camp is obvious, right? This is value stock, and you get, low price earnings ratio means, higher earnings power for its price, high earnings power for its price. But then high price earnings ratio camp, their argument is that the reason for high price earnings ratio, obviously earnings for price earnings power is low. You can say, think about it. If this price earnings ratio is 200, what does that mean? If the price earnings ratio is 200, and for example, if this is 5, it's clear. This means, for if the price earnings ratio is 5, that means for $5, for stock price of $5, the earnings per share is $1. But if the ratio is 200, what does that mean? For price of 200, earnings per share is $1, right? And who in their right mind would go for this? Who in their right mind will go for this, right? Who in their right mind will go for this? Anybody in their anybody with rational thinking would go for this, right? But then the argument from the high price earnings ratio camp is that the reason this price is supported, I mean, despite its low earnings per share, huh? Despite its low earnings power. And think about it. If this kind of stock is very expensive stock, isn't that right? For $1 earnings per share, the price is 200. So that is, clearly very overvalued stock, right? Overvalued stock, overpriced stock, and very expensive stock. But then the argument is, even if it is, such a, high price is maintained, that the and the price is that high price is maintained only because there is that strong demand. Think about it. For such a price to be supported, that means there must be strong demand for it. Even for that poor earnings power, there is a strong demand in the markets. People still um, want the stock. And why would that be the case? Why would people still, demand the stock? Because they all they are thinking that this company, uh, 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 this high price earnings ratio represents this high price earnings ratio represents present value of growth opportunity, right? And the present value of growth opportunity, um, uh, I mean, this stock would be the stock that pays no dividend. Think about it. If it pays no dividend, right? If it pays no dividend, then uh, plowback ratio will be 1, right? Meaning dividend payout ratio is 0. So all of its earnings is going back to the company, being plowed back into the company and being reinvested. So it has a huge growth potential. Well, so yeah, that sounds plausible. That sounds plausible. But then present value of growth opportunity is nothing but it's a fluff. In other words, if it comes true, only if it comes true, it is justified. If it doesn't come through, it's nothing but bubble. Think about it. Isn't that right? Is everyone following? Uh,
I'm following. So you're saying the present value growth opportunity is speculative in a way?
yes, you're right. Present value of growth opportunity is the result of speculation. Yes, of course. It may come true sometimes, but most of the times it's nothing but bubble. And then how do you know? How would we know if that present value of growth opportunity is groundless, baseless, or it is it has some ground? Well, so how do we check that? Again, price earnings ratio by itself is incomplete because price earnings ratio um, uh, by itself is incomplete because the high the proponents of high price earnings ratio is justifying it by present value of growth opportunity. But then how do you know the present value of growth opportunity is baseless or if it is based on some solid measure, solid indicator? Well, that's why we need PEG ratio. What is a PEG ratio? PEG ratio is price earnings ratio divided by growth rate. Okay, PEG ratio is price earnings growth rate. I mean, they just, think it is price earnings growth ratio, but growth means growth rate. So think about it. If, let's say, for example, price earnings ratio is 100, right? So that's a still very, a high price earnings ratio, because for $1 earnings per share, price is $100. But if it is, if the growth rate is also like 100%, growth rate of the growth rate of the profit, right? Or the growth rate of the capital gains, right? I mean, the growth rate we need to define. This is clearly not, it can mean, there can be a growth rate in price, which is, capital gains, growth rate in price, and a growth rate in profit. Growth rate in profit includes both, growth rate in capital gains and growth rate in dividends, right? So let's say growth rate in profit. If the profit grows by 100%, right? Then ignore this percentage, because 100% is 1, but just ignore this, ignore percentage. But if P ratio is 100 and the growth rate is, how do I, 100%, just ignoring that percentage, right? This ratio will be 1, right? Think about it. That means if this ratio is, it doesn't have to be exactly 1. If it is close to 1, then this high price earnings ratio is justified, right? Think about it. For a stock that grows by 100%, right? For a stock whose return grows by 100%, right? It isn't too far-fetched for its price earnings ratio to be 100, right? So, of course, then, the currently price earnings ratio is 100. That means, like, price is $100, but the earnings per share is only $1. So isn't it, even though the ratio is 1, is it justified? Look, that means a year ago, earnings per share was 50 cents. From 50 cents to $1 is 100%, right? Or from $1 to $2 is 100%. From $2 to $4 is 100%. I mean, such a growth in return justifies this, high price earnings ratio. Otherwise, if it is close to 1, but if it is, otherwise, if it is like greater than 1, let's say if it is greater than 1, if the PEG ratio is, if it is like greater than 1, something like, let's say, something like 2, 3, 2, 3, they are all what? That means they are bubble. It's nothing but bubble. Okay? It's nothing but bubble. Okay? If the PEG ratio is something like this, that's the indicator that it is bubble. Okay? And so that completes our discussion that last time, because I had to wrap it up, like, because at the last minute I couldn't quite So then let's move on quickly because we are kind of far behind. Um, so then we need to talk about the variable growth model, right? Variable growth model. Um, because we did, so far we did only two models. Third model is, dividend. Third model is product multi-stage growth model. It's called, variable growth model, multi-stage growth model. But there are like a multi-stage means it can be two-stage or three-stage or four-stage. But let me first pull up. And also, no, not this one. What am I looking for? Maybe. Okay, I'll have to open. Do I have it here? Yeah. All righty. So let's take a look at this example. Um, in Golden Growth Model, the dividend growth rate is assumed to be constant. But that's not the reality. No company grows at a constant rate. Usually, companies grow at first. They grow at okay. They grow at different rates. But you might wonder, isn't it only obvious? I mean, isn't it only natural? Because one year it can grow at 5%, another year it can grow at 3%, another year it can grow. Yeah, the growth rate is uneven. That's true. But when we say then then we can never have a constant growth rate. First of all, constant growth rate, I showed you last time in in Golden Growth Model, constant growth rate is actually, average growth, geometric average, right? Because in reality, nothing grows at an even rate. It's all uneven. But what is meant by constant growth rate is geometric average of uneven growth rates. But then even although every year the growth rate is different and uneven, but there is a big trend. There is a kind of uh, a big trend, right? The trend is when the company, when the product, this is called, product life cycle model, product life cycle, which is also um, in industry life cycle. I mean, if you expand the product life cycle, it's industry life cycle, right? And for example, sometimes a product represents the industry. What about, think about it, a smartphone. A smartphone is a good example of the whole industry uh, uh, built around. Uh, I mean, right now we have pretty much, of course there are other companies, but basically, in smartphone industry, it's Apple versus Samsung, right? Apple is pretty much the number one big player, but Samsung is very close. It's almost like, Coke and Pepsi. Of course, in the soft drink, in the market for soft drinks, uh, there may be smaller players, but they are almost non-existent. In the U.S., especially, there are some, companies like there's some brands. I don't know if they are just, uh, like low quality brand of Coke and Pepsi, but there's something called Shasta. I haven't seen Shasta in the East Coast, but in the West Coast there's Shasta, which is like Seven Up, and there's RC Cola, and RC Cola is actually like a secondary brand of Coke. But there may be some other companies, but they are very, globally, right? Other countries have uh, their own brand of soft drinks, like their own brand of cola, their own brand of Seven Up. Um, but globally, Coke and Pepsi are like two giants. Also globally, Samsung and Apple, they are two industry giants. But first, the smartphone first started out with Apple. Apple put out first its iPhone in 2007, and then, of course, before it came out, there was a lot of R&D, research and development, and the product was launched. And as the product was launched, uh, it grew at a very exponential. It grew exponentially at exponential growth rate. How do I know it is exponential? Now, uh, okay, there can be three types of growth pattern, right? First of all, let's think about it. Growth can be use my the horizontal axis is the timeline, right? The vertical axis is dollars. In other words, like sales revenue, right? So if you see this kind of trend, that's clearly growth, right? But then again, there is no growth like linear. There's no such 45-degree linear growth like this. I mean, that's unthinkable, right? In reality, but let's say even if it grows like this, right? It's called a linear. And if the growth is, if it is linear, the slope of this straight line, the slope, right? Delta, right? Slope represents growth rate. It's rate of change, right? The slope is rate of change, so it's growth. And the slope of a straight line is constant, right? Right? It's constant. Another pattern is something like this, right? What do you see? It's growing at a fast rate. It grows at a fast rate early on, but the growth rate gets smaller, or growth rate goes down as time goes on. Why? Because the slope, this is the slope. A curve has many slopes. A curve, slope of a curve is defined at every point. Now the slope is like this here, but the slope is like this here, right? It's the tangent, right? The slope is the slope of a curve varies over time, right? It's the tangent line at every point, right? But what do you see here? You can tell slope is getting flatter. First it was steep, but it's getting flatter and flatter. And at some point it is flat, right? If it is flat, then that means growth rate is 0. If it's flat, that means growth rate is 0, right? And then if the slope now here, slope is slightly negative, right? At that point, the slope is slightly negative, right? In other words, sales revenue is going down. On the other hand, so you can have a growth pattern. It's so messy, but you can have a growth pattern that looks like this. I'm going to have to redo. So I'm going to have to let me get rid of all these dotted lines. But you understand what I'm saying, right? Because another case of growth would be something like this, okay? And this type of growth pattern will show you, right? First, slope is flat, but it gets steeper and steeper, steeper, steeper as time goes on. So, in other words, the growth rate is increasing, right? Growth rate is increasing, whereas in this case, growth rate is slowing down or decreasing. And if it shows this pattern, it's called decay. This is a decay. This pattern is decay, right? This pattern is this decay. And this pattern is called exponential or exploding, explosive. Growth is exploding, right? Isn't that right? Growth is decaying in this case. Growth is, in this case, growth is decaying. Whereas in this case, growth is exponential or exploding, right? And why is it called exponential? Because that is exactly following exponential function, the power function. For example, if call this y, call this x, right? And then um, in this case, y is power functions. I don't know. I don't want. Well, I don't know. For example, there's a base, right? Um, this function is, expressed by y equals a to the power of x. So that means, x is, this time, for example, 1 year, 2 year, year 3, year 4, year 5, year 6, year 7, right? Year 8. And if the base is, for whatever, it grows at an exponential rate. In other words, for example, if the base is 2, right? In other words, each year, think about it. If the base is 2, then in year 1, revenue will be 2. But in year 2, revenue will be 4. Year 3, revenue will be 8, right? In other words, revenue of year 1, let's say, that's revenue of year 1. And then revenue of year 2, revenue of year 3, right? In other words, revenue of year n, then, n years later, I'll have to, use ellipsis, meaning n years later. Year n to the n, right? Which is, the power function is, exponential function, right? In other words, power function is the exponential function. So it follows. And the exponential function exhibits this pattern, right? This is exponential, this is decay, and the middle one is linear. And think about it. I said early on, growth is exponential. So early on, what do you see? Isn't this pattern isn't this exponential? This pattern is exponential. And after a certain number of years, then it goes into a decaying pattern, right? From here, it goes into It's so hard to like decay. And decay means, like here, it has a certain constant range, constant growth range, okay? And then when it hits this point, not there, actually, more like this point, then the growth rate is 0, right? The slope is 0, the growth rate is 0, right? For competitor, it happened. For the competition, it happens at this point. For this company, it happens at this point. And after that, the slope is negative. After that, the slope turns negative, right? Meaning growth rate is negative. Now, so think of it this way. The green curve represents the innovating firm. Innovating firm means simply the company that put out innovative product. Okay? Innovating firm doesn't necessarily mean it's constantly innovating. Of course, we hope the company would be constantly innovating, but what it means is it came up with the innovative product. Now think about it. The smartphone was an innovative product. Isn't that right? There was cell phone before iPhone, but the regular cell phones were not a smartphone. Smartphone was an innovative product, right? So Apple was an innovating firm. That means it came up with the innovative product. And then early on, there was a monopoly. Only Apple had, right, smartphones. That's the called stage one. And so in stage one, what is going on? No longer. I have it. Stage one. What's happening? It's there. Okay. Anyway, it's called stage one. And during the stage one, they have monopoly power. They are almost monopoly. And then the company in stage one, the company is growing at an exponential growth rate, but as it enters the stage two, which is and then when it enters stage two, then it goes into relatively constant growth rate. So right, this is the period of constant growth rate. This looks stage of constant growth rate relatively. But then you might wonder, why is it called growth stage two? Why is it called growth stage? I mean, wasn't it already growing out of? Shouldn't it be called like steady growth stage rather than just growth stage? Because anyway, the company was growing exponential rate even in stage one. I mean, here it was growing at an exponential rate. The reason it's called growth stage is because from the entire industry's perspective, right? this is the time, this is the stage where the entire industry is growing. And because the competition came in. I mean, when there's a when there's a competition, then obviously that means industry has expanded. Industry has competitors came in, and there are more of competitors than iPhone. So competitors grow, and when there are more competitors, right? The whole as an industry, the total of their sales revenue would be greater than just one company, a single company. And then stage 3, they go into the maturity stage, maturity. Maturity stage, right? And during the maturity stage, the competitors' growth comes to a halt, right? Like here, right? And then the innovating firm in stage 3, they're already into decline. But again, this is not the reality. This is just a stylized graph. So in reality, Apple, I mean, if it is smartphone industry, Apple has never entered this stage 3. Apple isn't declining. It's just a stylized, graph. Apple is still growing. Like, for Apple, it would still be like, although slow, Apple would be something like, let me use a different color. Apple is still something like, I would say, something like this, still here. Apple would be still something like that. And the industry hasn't peaked out yet. So basically, based on this, we can tell 3 steps of growth, or 3 stages of growth, right? First, exponential growth, steady growth, right? Then steady growth, and plateau, right? Zero growth, and then negative growth. But then think about it. If you are investing, what matters to you is only first 2 stages, right? If you're buying stocks, for what is relevant to you is only this exponential stage. And although the pattern looks like decay, but I should call it constant. The constant growth stage. So constant or steady. Constant growth or steady growth. Constant or steady. So think about it. If the company has reached this point or beyond, you must sell. You must sell the stock. You shouldn't keep it in there, right? So although there can be 4 stages, what is relevant to you is the fast or exponential growth stage, and constant or steady. Constant or steady growth stage. Okay, does that make sense? So then that's why we come to this 2-step or 2-stage model. I mean, there is 3-stage model example but we don't have time for that. We're just gonna talk about the two-stage model here. So here we have an example from the next slide. Okay, we're gonna talk about that after the break. It's 7:18 right now, so we're gonna take a 10-minute break, a 12-minute break, and reconvene at 7:30. Okay, we'll reconvene at 7:30. All right. So, all righty. I'll okay. I'll All right, we're back. We're back. Oh God, I have only 7 people, huh? We have, this is a class of, let's see, this is a class of uh, 2022 by the roster, right? And we have only 22 people in the collaborate. Let me just check how many are. And, so 14 people, right? 14 people. So, and we have 7. So half, 7 out of 14. Only half are participating in collaborate. Okay, so no matter what. So now, so let's take a look at this example. The most recent annual dividend payment of Warren Industries, a rapidly growing boat manufacturer, was $1.50 per share. So most recent, that's times 0. So 2012 is times 0, meaning, end of 22. End of 22 is times 0, right? Because you cannot have dividend at the beginning of 2012. You cannot have dividend at the beginning of 2012. For the dividend of 2012, the 2012 has to end. So our time 0 is end of 2012. Time 1, 2013, was $1.50 per share. Okay, and why did it say rapidly growing boat manufacturer? I mean, um, I don't like verbiage, right? I don't like verbiage, but so the name of the company doesn't matter, right? We can call it company X or company W. And rapidly growing, which is an adjective phrase. Adjective. It's an adjective, right? Isn't it? It's an adjective. Um, growing, rapidly, adverb, right? Rapidly growing, adverb and adjective. Adjective. But is it really necessary? I mean, usually adjectives are for, descriptive uh, purpose. In literature, adjectives are very important. Uh, but then, in science, is adjective important? I mean, in science, if it is fast, then you don't say fast, you will say accelerating, right? Accelerating at a high rate. Well, let's just read through it. Um, the firm's financial manager expects that these dividends will increase at a 10% annual growth rate. I call it G1. I mean, it wasn't originally there. I just called it over the next 3 years. What that means is over the next 3 years, it will be growing rapidly, and the rapid growth rate is 10%. Okay, dividends will grow rapidly at 10%. That's G1, right? Dividend growth rate 1, first phase. At the end of 3 years, so that will be end of 2015, the firm's mature product line is expected to result in a slowing of the dividend growth rate to 5% per year, which is called G2, for the foreseeable future. Then think about it. Why does it say, firm's mature product line? I mean, of course, the whole story to fit into place. They are the sales revenue will mature sales revenue will grow to a steady level. In other words, steady growth rate. Firms mature. Mature means the company isn't growing anymore. The product isn't growing anymore. Mature. Mature means, think about it. When you're mature, you don't grow, right? Physically, you don't grow. And of course, intellectually, if you're mature, does that mean you don't grow anymore? No, intellectually, actually, there is no maturity. I mean, intellectually, you can grow even more, but there's a certain maturity in intellect, right? But at the end of so this is a typical example of two-stage growth model. For example, for the first 3 years, it grows at a fast rate, right? The first 3 years, right? Okay. This is the first 3 years, right? This is the first 3 years. G1. It grows at fast growth rate of G1. And after 3 years, right, it slows down to G2, 5%. Growth rate will be constant. And then it says, beyond that, no more, growth rate forecast. I mean, it just says 3% G2 for the foreseeable future. That means, it will go into the steady growth rate, and as long as we can forecast, it will remain at 3%. And again, if beyond, look, if the growth rate goes into like 0%, right? If it goes into if the growth plateaus or growth rate goes into 0 or negative, then we're not going to bother anymore. We're not going to hold this stock anymore. We're going to sell. So while the forecast is constant, right? Then that's what matters. So in other words, the scenario is, right? I'll just use D0. Dividend at time 0 is $1.50, right? And then this time 0 is, time 0 is 2012. And it's going to continue, right? It's going to continue until 2015. And dividend grows at G1, right? Which is 10% until T3, which is 2015. And beyond 2015, and then growth rate will slow to 5%, right? Beyond T3, right? So what does this mean? I mean, growth rate will be steady or constant. If the growth rate, dividend growth rate is constant, uh, what is the Q? It's the Q for, I want to, okay, constant growth rate is the Q for golden growth model. Is the Q for the golden growth model, right? Golden model. Okay, that means for golden model for what? I mean, for stock price, that means, stock price at time 3, right? End of time 3, right? Stock price as of end of 2015, right? Will have to be calculated this way. But then we are at time 0. In other words, um, once we can find stock price at the end of 2015, right? We can find the stock price as of end of 2015, right? But the problem is we are at time 0. I mean, what the stock price we want to know, stock value we want to know, the intrinsic value of the stock we want to know is the, the price at time 0. Then how do we do that? Well, we can do that because we can discount V3 by, 1 plus K. We can discount it 3 years back, right? And plus all the dividends between time 0 and time 3, right? We can, because the dividends will grow between 2000, that's not, because between 2012 and 2015, the dividends, there will be 3 dividends, right? 2013, 2014, and 2015. Those 3 dividends we can forecast because they will grow at 10%, right? So we will discount. Of course, they will be all discounted at different because this is not a very good notation for that, but it will convey the idea. Now we can find the price at time 0, stock price at time 0, because we can find stock value at the end of year 3 using golden growth model. We can discount it 3 years back to time 0, and all the dividends, between time 0 and time 3, right? We can discount it. I mean, the first one will be discounted only once. Second dividend will be discounted twice. Third dividend will be discounted 3 times like this. So I'm going to, so this notation, I mean, this expression is not exactly correct. especially this part. This part is not exactly correct. I'm gonna uh, clean it up later. But let's take a look at the solution. So here's the Excel model I used. And you can all find this. This is the file that's posted there in the, right? In the equity valuation, right? This is the Excel file, right? Stock valuation XLS. That's the file. If you download it, you will find it. And I want you to do it with me all together simultaneously. So I want you to have this file opened in front of you. Do you have this file in front of you now? Let me blow it up a little. Let me make. Okay, who is there now? Larissa, are you there, Larissa? Larissa? Anna, are you there? Anna?
Yeah, I have it open, sir.
Okay, great. Damien, are you there, Damien?
Yes, sir. I'm here, sir.
Okay, Damien, do you have this file open in front of you? You have this
No,
file?
sir. No, sir. I told you I had problems with the computer files as it is, so I'm just listening right now.
Okay, all righty. But can you see? Can you see this?
Yes, I can see it. I can see it.
Okay, all righty.
All right.
And then who is there? Ibani, are you there, Ibani? Ibani? Ethan, are you there? Ethan?
Yes, I'm here.
Okay, Ethan. Do you have this file in front of you?
Yes, I did.
Good. Giselle, are you there, Giselle?
Yes, I'm opening the file right now, sir.
Okay, great. All righty. So I would assume that everyone has this file in front of you. Now, first, step one, right? We will need to first generate the forecast of. We'll need to generate the forecast of these for the next 3 years, dividend next 3 years. So at time zero, which is 2012, dividend was $1.50 was given. And then, okay, I want you to clear out everything here. Just delete everything. And then it's not a difficult thing. All you need to do is just, dividend at time zero, and you compound it by growth rate 1. And here, growth rate 1, I'm going to lock it, right? Because I'm going to drag it down, and as I drag it down, then I don't want this, whatever is in G27, D27, I want it to be there. If I drag it down, it's going to change. So hit function key F4. If you hit F4, right, you will see the dollar signs around it. So it gets locked. So then I can just drag it down. I can drag it down like this. So I have, my forecast of dividends based on this 10% growth rate, right? It's going to be like this. And then I need to I will need to find the present values of all of that. So to find present value, all I need to do is I will simply, this is what I did there, I will simply discount this by 1 plus the required return. And of course, I will lock, because I'm going to drag it down, and then raised to these digits. Of course, first here it's going to be 1, so it's just, discounting once. And then as you drag it down, it's going to automatically, it's going to be then the dividend in year 2, right? Discounted by 1 plus r raised to 2, and so on. Okay? So this is the purple, or violet or purple highlight is the present value. So the present value of all these dividends, the sum of all of that, is this $4.12. And then we need to find the, and then after 2015, the growth rate steadies to constant 5%, meaning that we'll need to find the stock price. It's better like, I should, I used P, but, it should be V, right? Stock price as of, end of 2015. And to do that, what do? Of course, I use, a golden growth model. So to use golden growth model, I'll need to forecast 2016 dividend, which is, this times 1 plus then growth rate, which is, 5% there, right? $2.10. And then golden growth model is what? Dividend at time t plus 1, which is this, over r minus g, right? So then I got this. But again, this is the value of the stock, right? At the end of 2015, right? As of 2015. It's not present value. Our time zero is 2012. So what do I have to do? I will need to discount it to time zero. If you discount it to time zero, then this will be, right, discounted by 1 plus, right, E27, which is, discount rate, the required return, raised to 820, 3 years, right, for 3 years, right? You discount it back. Then the present value of this stock is 1379. Then finally, for the price of the stock, right, intrinsic value of the stock at time zero, or 2012, right, which is our time zero, what do I need to do? I will need to add these two. That's it, because this is present value of all those dividends. This is the present value of the stock as of the end of 2015, but present value of that. So present value, you add them up, right? So you come to, right, $17.90. Okay. Now, everyone understood? If you're done, try this. Delete everything. Okay. Delete all the highlighted cells and try it yourself. Okay. Tell me what you got. Can you retrace? Can you retrace everything? Can you backtrack everything? I'll give you 5 minutes and let me know what you got. It's 7:56, so at 8 o'clock, let me know if you got it right. Okay? All right, so it's 8 o'clock. Your time's up. So, were you all able to reproduce the same result? Hmm? Anyone? I only have how many people? 6 people. Um, everyone was able to reproduce the same result? Hmm? Tell me. Anna,
I'm not quite done, but I'm not quite done, but I can
you're
do
getting
it.
there.
I
You're
get it.
getting there, right?
Yeah.
Okay. Ethan, are you getting there? Did you get the same result?
Not yet. Still working on it.
Okay. Giselle, did you get the same result?
I'm still working on it right now.
Still working on it. Okay. All righty. How about Larissa? Are you there, Larissa? How about you, Ibani? Ibani, are you there? All righty. I guess all right. So we can let's do it together. So first, we'll generate the forecast of dividend for the next 3 years, which is simply this times 1 plus this leads to this, right? And then actually, uh, I can do it in 2 ways, but let's do it this way. If I lock it, I'll lock it like F4, right? And as I said, by hitting F4, and I can lock these two, and then what happened? Oh, I didn't use any equal sign, right? This and I will lock times 1 plus the growth rate, lock raised to this digit. Enter and then drag it down. Okay? Or another way I can do it, I'll do it here. What I can do is I will point to this times 1 plus D27 lock hitting F4. That's it, because if I do it like that, if I drag it down, C27 will change to C28. C28 will be C29. So that way I can still get this. I can still get the same result. Okay. See what I did. But there is no compounding, because each time each time the dividend is always dividend is changing year by year. That's fine. Either way, however you did it, that's fine. Then let's find the present values of all of these, and that's this over 1 plus R and lock it by F4 and raise to. Okay. And then I'll drag it down. Okay, so yeah, this discounted by 1 plus this raised to 2, right, and so on, the same thing, right? And then I just use auto sum, using auto sum everything there. Okay. And then next, step 2, we're gonna forecast 2016 stock price using the slow growth rate, right? Steady but slower growth rate. So then 1 year ahead, forecast just 1 year ahead. It's going to be $2.10, and then since it's Gordon growth model, the stock price is the stock price as of 2015, and then so dividend of 2016 will be discounted by R minus G. Okay, there you go. That's going to be 2096, but this is 2015 stock price. We must discount it to present 2012. Then here, the present value of that, simply this discounted by 1 plus R. We're discounting 3 years back. 3 years back. So that. Hit enter. 1378. And then finally, so the stock price as of 2012 must be the sum of these two present values. Okay, and there you go, 1790. Okay, so everyone, I hope everyone got that. Now, so let's take a quick look at how much difference it makes, right? Dividend, the companies that pay out dividends and the companies that don't pay out dividends, right? So these are the first group of companies, are the companies that, look, their dividend payout ratio is either 0 or 20% or 30%, right? 14%, but a lot of them are not paying out dividends. Adobe didn't pay out dividends. Cognizant, 0. CompuWare, 0. Intuit, 21%. And then Microsoft, 30% they paid. Microsoft was, I don't know as of when. This was probably 2012. Yeah, looks like it's 2012 data because here 2012 value line. And then Microsoft was already, kind of maturing company, right? At 2012. So they would Oracle 14%, but most of them were 0, and SAP was paying 20%. Median payout ratio was 0, right? And then that means if median payout dividend payout ratio was 0, then plowback is 100%. So then growth will be very high. So let's think about it. These are the return on capital, return on K, rather than return on equity, right? Return on equity, return on capital is basically EBIT, right? I'll have to write it here. Where's my, okay. What is return on capital? It's like return on equity. Instead of equity, simply use long-term capital. Okay, long-term capital is basically equity plus long-term debt. Long-term debt means not current liabilities, but long-term debt like bond, right? And then I would use EBIT here rather than EAT. EBIT. Why? The operating profit, because EAT is the EAT belongs to the equity holders, right? But it doesn't belong to the debt holders. Therefore, for the debt holders, right, long-term capital debt holders, there must be something for debt holders. So that's why I'm using EBIT, which is operating capital, right? It includes interest that belongs to the interest that belongs to the debt holders. But the effect is pretty much like EAT. ROE effect is pretty much like ROE, right? And then so their median return on capital is 18.5, and then of course we will need to multiply. That means for this company, for most of the companies, the plowback ratio is 100. For this company, for Intuit, plowback ratio is 79. For Microsoft, plowback ratio is 70. For Oracle, plowback ratio is 86. But you know what we need to do? This times 1, this times 100%, this times 100%, this times 100%, this times 79%, this times, and then if you do that, growth rate will come out like this. And then it's not exactly, this times 1 will be 19%. Why is it like this? Somehow they made some adjustment. Eventually they must have used return on equity. Although they used return on capital here, they must have used return on equity. But anyway, the growth rates median is 13.3%. But then look at the electric utilities. Compare electric utilities are mature firms, think about it. They have hardly, any room for growth. I mean, they are natural monopoly, right? Con Edison, their market is already, Con Edison has already its own customers. Geographically, it cannot grow into other market because other geographic market is served by other utilities. Mostly utility companies are therefore mature companies because their growth potential is zero. So their return on capitals are like this. And then their dividend payout ratio is quite high compared to these computer software companies. Their dividend payout is quite high. Median is like 60%. They are paying out 60%. And their return on capital is low because they are mature companies. Generally, they have low return, meaning they are not growing fast. And then this times this although they presented return on capital for actually growth rate calculation, they must have used ROE, return on equity. So growth rates are very low, as you can expect. And the median growth rate is only 3.8% compared to computer software group, right? It gives a stark contrast. It gives a stark contrast. Okay. So next, this is a three-stage growth model. It's more complicated model. We don't have time for this, but in the main lecture, I explained everything in the main lecture. So if you revisit the main lecture, of course you may have watched it, but you must have forgotten. By now you must have forgotten. So I want you to go back and watch that video on YouTube. Okay. Now the fourth model, I've been telling you over and over. There are four stock valuation models. Four types of DDM. Stock valuation models are basically all DDM, dividend discount model. But the only thing that is not the only thing that's not DDM is the free cash flow model. Okay, of these four, three are DDM, dividend. Okay, of course, the first one is constant dividend or zero growth slash or perpetuity model, which is I'm not going to write this because it just takes too much time. Perpetuity model, so which is constant dividend, right? It doesn't grow over R. Second one is golden growth model or constant growth model, which is dividend at time t plus 1 over R minus G, right? Which can be rewritten as dividend at time 0 times 1 plus growth rate. It's hard to write this. Okay, or R minus G. Now, third one was, variable growth model. Variable or multi-stage we just did that example, right? Multi-stage growth model. And these are all DDN, right? But the fourth one, free cash flow model, is not DDM because it doesn't have any dividend. It doesn't, it's still, a discounted cash flow model, right? It's still discounted cash flow model, but, you're not discounting dividend, but you are discounting free cash flow. Discounting free cash flow. So let's take a look at the example. Because not all the companies are paying dividends. First of all, what is a free cash flow? Okay, free cash flow is defined this way. Free cash flow is operating cash flow minus investment in operating capital. What is operating cash flow? Operating cash flow is EBIT minus taxes plus depreciation. Okay? And then what is investment in operating capital? It is changing gross fixed assets plus change in net working capital. Now, so let me break this down. So I should have put it here. Give me a break. Although it's not dividend discount model, it's still discounted cash flow model. It goes without saying. It's clear. Free cash flow is operating cash flow minus investment in operating capital. Then what is operating cash flow? EBIT minus taxes. Let me do this. Is EBIT. And what is another name for EBIT? EBIT is earnings before interest and taxes, right? What's another name for that? Anyone? What's another name for anyone? What's another name for EBIT? Nobody knows?
Is that the Oh my gosh. Sorry, sir. I forgot. Sorry.
Profit.
Okay, anyone else? Anyone else?
Profit.
EBIT? Yeah, but the word profit is too vague because there is gross profit, there is net profit, there is operating profit. What is it? Hmm?
Operating profit.
Yeah, EBIT is operating profit. Yes. Okay. Operating profit. Now, so operating profit, operating cash flow, they sound like something similar, isn't it right? Um, well, they are like counterparts, but they are not the same thing. Um, so let me first, investment in operating capital is change in delta means change, right? Change in let's just uh, let's just forget about gross. Just fixed assets. Change in fixed assets plus change in net working capital. Okay. Um, then think about it. What is operating profit? We know from balance sheet and income statement, from financial statements, especially income statement. In income statement, um, the first primary source of income is revenue, right? Primary source of income is revenue. Secondary source of income is passive income or investment income. Passive income. Investment income, such as investment income. Now, these are two major sources of income. And then expenses or cost. There is CGS, first source of expense is CGS, which is also called the direct cost. Direct cost, also called the total variable cost in microeconomics. Second one is OPEX, operating expenses, right? Which is also called, indirect cost. And roughly equivalent to total fixed cost in microeconomics. Now then, what do you do? Of course, when there is all the income there and all the expenses there, you'll have to subtract. Isn't that right? You'll have to subtract. And then you arrive at operating profit, which is also called EBIT, earnings before interest and taxes, right? And then think about it. If you subtract from this, subtract only this, right? Subtract only this, then subtract only that, then it's called gross profit, or gross margin. But this one, I don't like gross profit because it's not really the true profit. The true profit starts from here. Again, this is not the real McCoy profit. Why? Still, the name is EBIT, right? That means, that's earnings before interest and taxes. So the name already predicts that you have to pay interest and taxes, right? I like this name because it's self-explanatory. It's self-predicting and self-explanatory, right? So EBIT, from EBIT, that means what? You have to subtract interest. You'll have to subtract interest, right? Because you owe interest to the debt holders. And then once you subtract it, then it's called taxable. It's called taxable income, right? Taxable income or earnings before taxes. Taxable income or earnings before taxes. And then the name is earnings before taxes. So what does it imply to you? What is that telling you? The name is, earnings before taxes. So that implies that the next thing to do is paying taxes or subtracting, so you subtract taxes. And then after subtracting taxes, then you are finally at true profit, net profit, or EAT, earnings after taxes, right? But this is the true profit, right? EAT. Now then think about it. Operating profit, that is like the counterpart. I mean, operating cash flow sounds like operating profit, but the difference is, what's the difference? This is the operating profit, and operating profit is not exactly cash flow. Why? First of all, it's not all the cash flow. Out of this EBIT, taxes, you can't touch it. You can't touch it, right? But, depreciation is something that is being added back. Depreciation is something that's added back. I'm also this semester. I'm also every semester. I'm teaching, Finance 300 and 230 and 100. So sometimes everything gets duplicated. A lot of things get duplicated. I explain what I have to, but what I explain in Finance 230, I shouldn't need to re-explain it in Finance 300, because if you're in Finance 300, normally 230, it is assumed that you have taken 230 as well. Although that's not a must. I mean, the only prerequisite to this course is Finance 100. So somewhere in Finance 100, I said this. I have, but the point is, depreciation is not. Although depreciation will be part of OPEX, operating expenses, right? Here, depreciation is one of the line items of OPEX. So it's like, as if, it has been like expended or, paid out. Okay. But the reality is, depreciation is non-cash layout. What does that mean? What does non-cash layout mean? Non-cash layout means it is earmarked. It is treated like an expense, but actually it is hollow expense. It's not really expended in that year, but it is just, a placeholder. It just holds the place there like expense. So think about it. If $100,000 expense, $100,000 is listed as depreciation in the income statement, that actually means that $100,000 wasn't actually spent in that year, but it is, taking up as expense in that year. So what is that? That's actually then unused cash, or in other words, uh, that's cash available, right? Unused cash or cash available. So in other words, it's cash preserved. So it adds to the cash flow, right? Um, but taxes you can touch it, so you have to take it out. So that's operating cash flow. Okay. Then what did I do? Um, oh no. Then what is change in fixed assets? Uh, Investment in now fixed assets will the value of the fixed assets change. And what is the fixed assets? Most of the fixed assets are, I should have put this there. Now let's think about it. Fixed assets are what? Fixed assets are basically plant and equipment. Isn't that right? The plant and equipment wear and tear. That's the main reason for depreciation. Plant and equipment wear and tear with usage. So as they wear and tear, the value goes down. That's what is, the source. That's the source of depreciation. But then think about it. As it wears and tears, the value goes down. But is that all? No. Think about it. Plant and the size of the plant and equipment, determines the production capacity. Isn't that right? If the value of the plant and equipment is, $10 million, think about it. If the value of the plant and equipment is $10 million, then the production capacity is basically limited by the size of the plant. And the size of the plant is limited by the dollar value of the investment in the initial investment in the plant and equipment. So initially, think about it. If the total value of plant and equipment is $10 million at time one, if it was $10 million at time one, and the plant size must be something that is supported by $10 million. And that plant can, let's say, produce 10,000 Model X computers, 10,000 Model X computers per month. That's the maximum production capacity. Now think about it. If the initial investment was $100 million, right? $100 million could have built a plant that would be 10 times the size of the current plant. And if that means, if the size of the plant is 10 times the current plant size, then the production capacity would be also roughly 10 times the current plant size. Make sense? And then with 10 times bigger the plant size, with the plant size 10 times bigger, the current one, the maximum production capacity of that plant will be not just 10,000 computers, but like 100,000 computers, right? 100,000 Model X, right? So think about it. At the beginning, at time zero, the plant was, the dollar value of the plant was 10 million, but as time goes by, the dollar value of the book value, which is the dollar value, of course, dollar value of the plant will decrease. It will depreciate, right? It will depreciate. Of course, it will have to depreciate because, because of wear and tear. And then at the end of year one, the dollar value of the plant will be like 9 million. At the end of year two, 8 million, and so on. At the end of year three, 7 million. But is that the dollar value that goes down? Think about it. It means wear and tear. And if the plant and equipment wears and tears with usage, what also goes down? Anybody? It's like a 0.5 point question. With dollar value of the plant depreciating year by year, and it is due to wear and tear. With wear and tear, everything must lose value, right? But other than the dollar value, what else also goes down? Think about it. When there is a physical wear and tear in the plant and equipment, what will also have to go down? Say that again?
The production, how much it produces, the equipment is producing.
Yeah. You got it right. And who was this?
Anna,
can you clean it up and put it in one word?
the production, what
Yes.
the equipment is producing is decreasing as well.
Productivity or the production level or output capacity,
Okay.
right? The
Yeah.
output capacity also goes down. Anna, you got 0.5 for that. Yeah. The production capacity goes down. So think about it. If the production capacity goes down, will the management just, watch it just hands down without doing anything? Huh? Think about it. If the production capacity goes down, that means, your output goes down. As your output goes down, your sales goes down. If your sale goes down, that also means what? Your market share will go down because you'll become your presence in the market will diminish, right? Think about it. If your production capacity is down to 50%, that means you lost. That means you will sell 50% less than what you did originally, and somebody will pick up your market share. Your market share will decrease by 50%. You will be losing to your competition. Your market share will be taken up by your competition. So no management will just watch it hands down. So what will they do? They will try to at least
get rid of it or sell it.
Get rid of what?
Because you're saying that the price and the market share is going down, right? So
market share is not price. Market share is not price. Market share is literally share, percentage of your share in the market, right?
Okay.
As the market share goes down, then what do you get rid of it? Get rid of what? The question. Get rid of then what? Plant and equipment? Get rid of your production capacity? Huh?
I don't know.
Think about it. You have to regain that market share. You have to regain that production capacity, right?
Mm-hmm.
You have to regain that production. So what do? You will need to at least replace the worn and torn portion of your capital, right? You need to replace the worn and torn portion of your plant and equipment. Simply replacing it will, so 10% of your production capacity went down. So you replace the worn and torn 10%. So then, your production capacity is back to 100%, back to 100, right? Each year you will have to do that if you don't want to lose the market share. If you lose market share, you lose revenue, right? Then, so actually what they do will be, there can be three things. It's called, all businesses will undertake three types of projects. Three types of projects. First one, as far as their capacity, production capacity is concerned, first one is replacement. They simply replace the worn and torn, right? Eroded portion of their production capacity. Second thing is expansion. You're not going to only replace what was lost, what was worn and torn, what was eroded, but you do more. And when are you going to, when is this going to happen? Well, if the economic growth is very positive and high, right? If the economic growth forecast is very, if the economic outlook is very high and positive, you'll expand. That means, then think about it. There will be a change in plant and equipment. First, there will be a change because negative change, right? Because the production capacity goes down with wear and tear. But if you expand the production capacity, it's not, the change will be no longer negative. The change will be positive, right? And the third, so in other words, if you are expanding the production capacity, there will be a positive change in fixed assets. The third one is new venture. You're not remaining in the old business line. You're even venturing out into different business line or different industries. That's new venture. Either way, expansion or new venture, either way, it will bring a positive growth, positive change in fixed assets, because expansion, yeah, it will be, more plant and equipment. New venture, there will be more plant and equipment, right? Or, it could be the same, but think about it. If expansion requires replacement, expansion, new venture, they all require capital, cash flow. They all require cash flow. Where does the cash flow where does it have to come from? It has to come from the operating cash flow. It has to come from this. In other words, from this, right? It has to come from this. And then change in net working capital. What is net working capital? Net working capital is basically current assets minus current liabilities. That's working capital. Definition of working capital. Net working capital. Net working capital is current. Why? Current assets, another name for current assets is working capital. It's working capital. So net, you subtracted current liabilities, net working capital. Now, if so, it's about change, right? If the net working capital changed, right? What does that mean? If the net working capital changed, what does that mean? And if the change is positive, what does that mean? If the change is positive, what does that mean? The difference between the two, this current assets is greater than current liabilities, right? Then net working capital will be positive. That means, you have more current assets, right? It will for this to become positive, you must have more current assets than current liabilities. For this change, and this change can be positive or negative. If it is positive, that means you have more. But where did that current assets come from? Current assets that should support the positive net working capital must come from also this. Okay, so this is called, sometimes, so back to the change in gross fixed assets is also called CAPEX, capital expense. Capital expense. Think about it. You're expanding your physical capital, so capital expense. You need capital expense. So anyway, the bottom line is, this is how free cash flow is defined. And once we reach this point, this free cash flow is completely at the disposal of the firm. So that's also called free cash flow available to the firm. I mean, this free cash flow, there are two types of free cash flow, but they come from the same thing. I know we are past the two types of free cash flow. Free cash flow to the firm and free cash flow to the equity holders. And this is free cash flow to the firm, actually. In other words, this is free cash flow to the firm, actually, right? And then after making some adjustment to that, then we can arrive at free cash flow to the equity holders. Okay, we're out of time, so we cannot do more. But this is how free cash flow is defined. Okay, just because it is free cash flow, it's not like libertine. It's not liberal, right? It is really, really strictly, rigorously defined. So that's all the time we have for now. So we will have to, this goes to another week. The free cash flow model goes to another week. I will, but that's all the time we have. I will see you guys next week. Have a great weekend. Have a great weekend, and watch out for the announcement about the midterm 2. Okay. All righty. I'll see you guys. Take care, everyone.
Good night. Bye.
All right. Good night, Anna. I will see you next week. Okay. Signing out. Stop recording.